Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, November 8th, 2025. Hey, how you doing? I hope you're having a good weekend. I hope you had a good trading week. I know, the market was quite volatile last week, and we had a big move to the downside. So I hope you're staying safe and that you survived the week. Personally, I had a pretty good week all in all. I didn't have any huge winners, but I was green on the week. And considering the week, putting that in context, I'm very grateful for that. So, um, listen, I hope you're going to learn a lot today. I have some good things to show you and to teach you. And if you do find anything valuable in this podcast today, I would really appreciate if you would hit the like button and or subscribe. That would be great as well. But here's the format for the podcast today. So first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions and all the trades that I made last week. We are going to talk about when I entered the trade, why I entered the trade, what the setup was, what the confluences of signals were, how I'm going to position size, where I'm going to place my emergency stop, where I'm going to place my end of day stop, how I'm going to take partial profits if the market moves my way, and then ultimately how I am going to exit the full position, whether it's to the upside or hits one of my stops. So I hope this gives you a good idea of how I look at the market, how I wait for setups, how I look for the confluences, and then how I manage the trade going forward. I had some winners this week. I had a couple had a loser this week, but I'll show you all of this as we go forward. After that, we're going to talk about trader psychology. I've been trading for over 30 years, everybody, and every day, uh, the idea that the mind is the most important factor in your trading. We have so many things that we deal with. We deal with ego and euphoria and depression and angst and FOMO, all the stuff that happens in the market. Oh, it's fun until you lose a lot of money, right? So I say this every week. You have to get yourself a process, whether you get it from me, learn it from me, or learn it from someone else. Really, it doesn't matter. But the most important part of it all is that you have to get yourself a process, and then, like a laser beam, you have to focus and follow it, win or lose, because in the long run, in the long run, if you have a good trading process that follows good trading principles, in the long run, you have an edge and you will make money. It's like in Las Vegas, right? The casino has an edge in every game they have, right? Craps, roulette, blackjack. Do they win every hand or roll the dice or spin of the ball? Absolutely not. As a matter of fact, their advantage, their statistical advantage is quite small. It's from like basically 2% to 5%, but they follow the rules and they lose close to 50% of the time. But the times that they do win, plus that mathematical advantage, is how they make all the money. Well, let me tell you something. The edge that you have in trading is much higher than a casino edge. So don't worry about losses. They're just part of it, just like a casino. They don't win every hand. I mean, you don't see casino executives, they lose 10 hands in a row. Somebody wins 10 hands in a row in blackjack. They're not like, oh my God, clutching their pearls. We got to shut things down, right? Losing is just part of it. It's just that you want to lose less and win more. And in the long run, let your mathematical advantage and your edge play out. All right. So we'll talk a little bit about trader psychology and how important that is. It's always helpful for me to teach it. I hope it's helpful for you to learn it. After that, I did go down through my master watch list last night and I did identify some potential trades for next week. With this correction that the market has had, it gives us a good opportunity to buy some things on sale. I never chase things up near this second ATR channel, third ATR channel. I always wait for things to go on sale, usually come into an order block or a major moving average. And we've got some good ones. So I'll highlight these particular ones that I'll be watching very closely next week. They're not where they need to be yet. If they were, I may have already taken the trade, but they're getting close. They're getting close to some potential confluences. And when I'm talking about confluences, I'm talking about order blocks, major moving averages, RSI levels, possible MACD divergences, RSI divergences, ATR divergences, and taking this all in together and looking for just, that confluence of the stars lining up. Even when the stars line up perfect, doesn't mean you're going to have a positive trade, but it puts the odds, it increases the odds in your favor, and really that's all we can ask for in trading, right? So I'll go through each one of those and I'll show you the ones that I like and what I'm looking for. So anyway, again, I hope this is going to be helpful today. Let's run the U.S. legal disclaimer, get that out of the way, and then we'll come back and we'll get started. So hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started with the current positions. First on deck is Disney. All right, I did enter Disney on 10/16 at 109.86. Why did I enter this? Well, let's take a look at the big picture of the chart and I'll tell you why. It was a confluence of an order block and a rejection of a major moving average. Let's first talk about order block. You can see this green box here. This is the order block, but what makes it an order block? This order block is all the way back here from 5/22/25, right? So long, many months ago. What makes this an order block? Well, in order to have an order block, you need the following pattern. You need a swing low. Now, a swing low is a low that has a higher low to the left and a higher low to the right. It's that simple. You can see this is a low, but the low to the left is higher. The low to the right is higher. That makes it a swing low. So first of all, I need a swing low. Then I need a swing high. Now, swing high is just the opposite of a swing low. It has a lower high to the left and a lower high to the right. Make sense? So here we have a swing low, followed by a swing high, followed by another swing low that's lower than the first swing low. That's the key. Swing low, swing high, lower swing low. And then when that is in place, you have to go back to your swing high. Well, the swing high was here, remember? Now, in the future, if the market moves up and goes above that swing high, now you have a market structure change. So let's look at it again. Swing low, swing high, lower swing low, and then here we go above that swing high. And this changes market structure to the upside. Now, as soon as you take out that swing high and change market structure to the upside, now you can define your order block. And your order block is simply the lowest closing bar before market structure change happens. So as soon as market structure change happens, just go to the left. Where's my lowest closing bar? Here it is. Now the high and the low of that order block moves into the future. And if and when it gets back to the order block, that's where I'm going to be looking to buy. I always use the word order block, but really I look at it, I think the better description of really what's going on is that this is the smart money area. Because look, we have a swing low, we have a swing high, we have a lower swing low, we have a market structure change. And did the market structure change work? Yeah, look at that. Skyrocketed up. Now, when Disney was up here at its highs, is it a fair statement to say the people buying back in this order block was smart money? I would say 100%. If you're up here and you look all the way down here In hindsight, yes, smart money was buying here, clearly. So what I'm looking for is I'm looking for a pullback to the smart money area. In the future, if it comes back into the smart money area, into the order block, does that mean it's smart money again? Not necessarily. Things can change, right? The economy can change, geopolitics can change, all sorts of stuff can change. But when it does come back to the order block, more times than not 100%, but more times than not, if it gets back to that smart money area, it's smart money again, over 70% of the time. And see, there lies your edge. But you have to be patient and wait for it to come back here, all right? So we define the order block, right? Swing low, swing high, lower swing low, market structure change. We define the order block, high in the low of the lowest closing bar into the future. Okay, now, I always like to mention that I like to have confluences of signals. Well, the signal here, when I bought it here on the 16th at 109.86, it rejected the high of the order block, meaning it came into the order block, but then it closed above the order block. That's a rejection of the high of the order block. If it came down to the bottom and went below it but closed back in it, that would be a rejection of the low of the order block. But you can see on the day that I bought it, it rejected the high of the order block. But that's just one signal. I like to have multiple signals, right? Let's take a look at the black line. This is the 200-day moving average. This is a key moving average that large financial institution and savvy investors like to key their trades off of. On the day that I bought it, it went below the 200, but then closed back above it. Just that by itself is a legitimate deep dip buy entry. And deep dip buy entries is, this is one of the strategies I use, one of the strategies I teach. That alone is a legitimate entry, okay? But not only did I have a rejection of the 200-day moving average, I had a rejection of the high of the order block. So there you go. There are the two signals, all right? So I entered here 109.86. Now, as soon as I enter, the first thing I need to do is, well, how many shares am I going to buy? Well, I use a simple formula. I've used it for a long time. There are two variables that go into figuring out how many shares you're going to buy. The first variable, how much money do I have in my account? Let's say I have $200,000 in my account. I always take 1% of however much I have in the account. If I have $1 million, 1% is 10,000. If I have 100,000, it's 1,000. If I have 200,000, it's 2,000. So let's just say for this example, I have $200,000 trading account. Times 1% is $2,000. Now, the next thing I look for is the value of the ATR times 2, or the 2 ATR. Right now, that's 402. What's an ATR? ATR is average true range. How much is this market expected to move in any one day? That's a 1 ATR. But I take that value and times it by 2, and the 2 ATR at this moment is 402. So 1% of 200,000 is $2,000 divided by the value of the 2 ATR divided by 4.02 tells me to buy 497.5 shares. So I'll just round that up to 498 shares. Okay. This is now the 2 ATR is now going to be in my emergency stop. So this is how we determine how many shares I'm going to buy. 1% of your account divided by the value of the 2 ATR. That's how many shares I'm going to buy. Okay. We have a rejection of the high of the order block. We have a rejection of the 200-day moving average. I got in 109.86. Boom. I bought my 498 shares, right? Now, the very first thing I do after that happens is I take my entry price minus the 2 ATR value, the one I just used in the math, right? And I take my entry price minus 402, put it down here. This is my emergency stop. So now, if I have 498 shares and it moves down 402, how much have I lost? I've lost 1% of my account. Okay, that's kind of my worst case scenario. And the reason I put it 2 ATRs below is if I put it 1 ATR below, well, it's just expected to move that much in a day. I want to be twice that. That's why I use the 2 ATR. So entry price minus the value of the 2 ATR, that is my emergency stop. If it comes down here and I hit it, I've lost 1% of my account. Not fun, but you can certainly recover from that, right? But the good news is, everybody, that this emergency stop only will happen about 5% of the time. The other 95% of the time, if I have a loss, it's not going to be because of my emergency stop. It is going to be because of my end of bar stop, which is going to be much closer generally than my 2 ATR. Well, I got in the trade because it rejected the high of the order block. I got in the trade because I had an intraday rejection of the 200-day moving average. That 200-day moving average, that black line, that is my line in the sand. That's my end of bar stop. The next day, if it just closes even 1 penny below that 200, I'm out of the trade. Yeah, okay, I lost a little money, but a lot less than if it hit my emergency stop. So again, the emergency stop, only about 5% of the time. The other 95% of the time, if I have a loss, it's going to be a much smaller loss because it's going to close below my end of bar stop. Okay? Okay. Now, the next thing I have to do is I take my entry price and then I look for the value of the 1.5. Okay, not the 2, but this time the 1.5. I take my entry price plus the value of the 1.5, which is 301. So I take my entry price, look for the value of the 1.5. What is it? It's up here, okay? I put the orange line. That is my trailing stop level. When you're in a trade and it starts to go your way, when it reaches a certain level in profits above you, then I want to go into trailing stop mode. I just want to tighten up my stop. You've heard, right? If you're in a trade and it moves up, tighten up your stop. Well, this is exactly what this is doing. So I take my entry price plus the value of the 1.5. Right now it's 301. I add it to the top. If in the future it gets to this trailing stop level, it doesn't mean I do anything. I don't take any action. Now it just means that I am now in trailing stop mode, which means that in the future, if I have a close below a previous bar's low, I'm going to exit half the position. Why do I exit half? Because if you start moving up and then the market is weak enough to close below a previous bar's low, that means that's kind of a warning that it could be coming back down. Doesn't always happen, but if it does, and I've moved a certain amount from my entry, I sell half. That has the effect of moving everything up, tightening everything up, because now I have half the position. Make sense? Okay, now everything I've talked about so far, as far as placing your end of bar stop, where is your emergency stop? Where is your end of bar stop? Going into trailing stop mode. These are all defensive moves, or in other words, if the market moves against me, I have to take action, right? But look, just like in any great sports team or sports in general, you can't just play defense. These are all defensive moves, right? I can have a great defense, my football team, but I also need some offense, right? And the offensive part is taking partial profits each day if it moves a certain distance from the previous bar's close. So let me give you an example of doing that. So this is a trade, Disney, that I'm in. It's very simple, really. You take the closing price of the day. The closing price right now is 110.74. So 110.74. Now I look for the value of the 0.45 ATR, okay? This is 0.45 of an ATR, average true range. It's 90 cents. All I do is add them together. Closing price plus the value of the 0.45 ATR, 110.74 plus 90 cents. My first profit target for Monday is 111.64. So how much do I take? If Monday it gets to 111.64, 10% of however many shares I went into the day with. If I go into the day with 500 shares, 10% of that, I sell 50, right? It's not the whole position. It's just 10%. I'm taking advantage of the market moving in my direction a little bit. So closing price, 110.74 plus the value of the 1.5 ATR, which is 301. Add those together, 111.64. That's the first profit target. Now, I place 3 profit targets. So how do I get my second profit target? I simply take the first profit target, 111.64, plus the value of the 0.45 ATR again, the 90 cents. Now my second profit target's 112.54. I need to place the third profit target. How do I do it? I simply take the value of the second profit target, 112.54, and I add the 0.45 to it again, plus 0.9. There you go. There are my 3 profit targets for Monday. And again, how much do I sell at each profit target? 10% of however many shares I went into the day with. If I go into the day with 500 shares, I'm going to put a limit order in the system to sell 50 shares at the first profit target, 50 shares at the second, 50 shares at the third. If it goes down on the day, I don't hit any profit targets. If I hit 1 profit target, great. If I hit 2, that's great. Really good. If I hit 3, that's fantastic. It's hard to get 3, but it happens. But if it goes down, you don't get any. Then you start again from the next day, closing price plus the 0.45 3 times. There you get your 3 profit targets. These profit targets really add up, everyone. They add up over the years, over the decades, a ton of them. And it's just smart. When the market is giving you something, sometimes you have to take a little, not all, but some. All right. Okay. So there's the basic setup of the trade. So let's kind of recap and we'll go forward and we'll run it through. Why did I take the trade here on the 16th? 2 reasons. Rejection of the high of the order block, intraday rejection of the 200-day moving average, the black line, entered at 109.86. I placed my emergency stop 2 ATRs below. My end of bar stops have closed below the 200-day moving average. I placed my trailing stop level 1.5 ATRs from entry, and away we go. Next day, what happens? Moves up, hit a profit target. Great, fantastic. Holding above the 200? Yes, it is. Staying in the trade. Next day, up again. Great. Sold another profit target into that strength. Fantastic. Next day, up big, hit multiple profit targets. Fantastic. Selling into that strength. And what happened? I got to my 1.5 ATR trailing stop level, which means now I am in trailing stop mode. It doesn't mean I'm doing anything. It just means now I'm in. Now it has been activated. And in the future, if I have a close below previous day's low, I'm going to get a half. Next day, down. No profit targets, but did not close below the previous bar's low, so no action taken. Next day down a little bit again, but it was way below the previous bar's low, but at the end of the day, it recovered and closed above. Remember, the important part is the closing price, and it closed below the previous day's low, get me in the trade. The next day, down. Closed below the previous bar's low after reaching trailing stop level. What do I need to do? I need to take off half of the remaining shares that I had. Look, I started down here. I sold into strength, so I don't have as many shares here as I did when I started, right? So when you're selling half, you're just selling half of the remaining shares that you have at that moment. And that's what I did. Closed below a previous bar's low after reaching trailing stop level, sold half my position, locked in a gain of 1.67%. Next day, up, profit target, fantastic. Next day, nothing, down, we're getting close to the 200-day moving average. Am I going to have to get out of this trade? Well, let's see what happens. Opens lower, goes below the 200 during the day, but then rallies, closes above the 200, keeps me in the trade. And look at this. I hit 3 profit targets in that day. Selling into the strength, 3 profit targets. Not bad, right? Next day, up again, another profit target. And then we kind of drip down and kind of drip down. no profit targets down. Thursday, again, we tested underneath the 200-day moving average, which would be my end of bar stop, but it was strong enough to close back above. That kept me in the trade. Had this closed below here, I'm out, right? But it closed above the 200, keeping me in the trade. And then yesterday, up a little bit and one profit target. So I'm still in the trade here as long as it's above the 200-day moving average. And so not a big gain on this trade, but considering the week that we had, I'm grateful to be green. The remaining shares on this particular trade up 0.78%. Here on the 13th of November, we have earnings. I do not hold through earnings, so prior to earnings, I will exit the trade regardless of where I am. Whether I'm down a little, up a little, doesn't matter. Don't hold through earnings, so I will exit on before 11/13/25, so because I don't want to hold through earnings. And again, the remaining shares up 0.78%. All right, let's go to Costco. Costco. I entered Costco here on the 29th of October. Why? Well, it's inside an order block. We can go back in the past, look for the order block. Oh, it's way back there. We won't do it. So I'll show the other ones. But trust me, this is an order block. And now, on the previous trade on Disney, I showed you there was a 200-day moving average and a combination of an order block. I love when there's major moving averages like the 200, 250, 300 inside the order block, or an under 30, over 30 inside the order block. But sometimes there are not moving averages inside the order block. And so when that happens, I either just have to take a rejection of the high of the order block or rejection of the low in the order block, unless we have some other structure inside the order block that is interesting to me. And this is interesting to me here on the 7th. You see this big up bar we have on the 7th? If you have a big up bar, from a Fibonacci standpoint, if you have a nice big up bar, if it comes back to halfway of that big up bar, generally you'll have some inherent support there. So you can see the green line that I drew here. This is why I drew it. We have a big up bar. I know more times than not, if we pull back to the halfway of that big up bar, that will be some inherent support. And so that's why I drew the line here halfway. I drew it into the future. And now this is a line in the sand that I can key off of. Well, I entered the trade here on the 29th. Why? Because we tested exactly that level that I was telling you about, the half level, and yet we closed above. Perfect. That's why I took the trade. So I got in 911, right? Position size, place my emergency stop. How far below? 2 ATRs below. Where is my end of bar stop? It is simply a close below this line. You see how close, how good my risk to reward ratio is on this trade to begin with. If I simply close below this line, the halfway of that bar that was up on 10.7, I'm simply going to get out of the trade. So it's very close to my stop already. So I have a very good risk to reward ratio. Okay, so after I enter the trade, again, I place my emergency stop 2 ATRs below. My end of bar stops close below that 908 level, the halfway mark. I place my trailing stop level 1.5 ATRs above, as always, and away we go. Next day, started off great, took off a profit target. Next day, down, no profit targets. Next days, up biggies, multiple profit targets. Did you notice on this day we tested that halfway again? Did you notice the day after I entered the trade, we tested it again? Here are two tests of that level, and they held. So again, next day up, profit targets. Next day down, no profit target. Next day up nicely, multiple profit targets. Next day up again, multiple profit targets, and I'm at trailing stop level. Next day down a little bit, Thursday down. First close below a previous bar's low after reaching trailing stop level. What do? I take off half of my position, which I did, locked in a gain of 1.36%. Friday, Started off with the bang, boom, up, sold into that strength. Again, took off profit targets, right? Playing offense. So going forward, if we continue to move up, I'll take more profit targets. If we come down and we close below this level, I'll get out. Again, on Thursday, where did we test? That halfway mark that happened keyed off of this day here on the 7th. Isn't that something? So the remaining shares that I have on this particular trade, up 1.24%. Not a ton, but in the context of what happened this week, very grateful for that. Oil, USO. All right, I entered USO all the way back here on the 20th of October. Why? Order block. Where's the order block start? Way back here on 5:30. We have a swing low, we have a swing high, we have a lower swing low, we break market structure to the upside. This defines the order block. It's the lowest closing bar for market structure, the high and the low. We move it into the future. After we broke market structure, we went skyrocketing up. Can you say that the people that were buying in the order block was smart money? Yeah, of course, clearly. So now we know where the smart money area is. Bring it into the future. If it gets there, you can potentially take the trade. Okay, that's exactly what I did here on the 10th. Why did I enter this trade? Simply a rejection of the high of the order block. You see how we came into the order block, but yet we closed above it? That's the high. Now, generally, I like to look for the confluences. I like to have the major moving averages or my line in the sand, like the midway points, right, or RSI levels. But this particular trade I took only because of rejection of the high of the order block. But the only reason I took it is because this order block is pretty narrow, right? It's not very tall, right? Kind of a skinny order block. Why is that important? Well, if I buy here, my stop is going to be a close below the order block. If it's a very tall order block, I don't want to do that, right? If the order block's from here to here and I buy here, well, then my stop's all the way down here. The risk to reward ratio is not very good. But this particular order block is pretty narrow. And so it still gives me a pretty good risk to reward. So rejection of the high of the order block, I got in at 67.81. Is that right? Yeah, 67.81. I placed my emergency stop 2 ATRs below. If it gets down there, I lose 1% of my account. It only happens 5% of the time. My end of bar stop is simply a close below the low of this order block, the low of the green box, 66.03, which is closer than my emergency stop at 64.08. Okay, so I know the reason I entered, I position size, know the emergency stop, know the end of bar stop, place my 1.5 ATR trailing stop level above, off we go. Next day, boom, goes up, I sell into some strength, some profit targets. Next day, up big, biggies, multiple profit targets. I took off into that strength, and now I'm at trailing stop level. Next day, up again, huge, multiple profit targets. I'm really selling into this strength, which is great. Next day, down a little, next day, down a little. Next day, we have our first close below a previous bar's low. After reaching trailing stop level, what do? I take off half of the remaining shares that I have, and I locked in a gain of 4.97. Next day, up, profit target. Next day, down, no profit target. Next day, up, profit target. Next day, up a little, not enough for a profit target. Then we move down, up a little on Friday, but not for a profit target. The remaining shares that I have here, up 4.83%. So really quite a good trade. Started off with being patient and waiting for a pullback to the order block, and it worked out just fine so far. Grateful, and I'm grateful for that. MO, Altria. All right, so this is kind of interesting for a variety of reasons. But let's start with the trade. I entered the trade here on the 3rd of November, at 56.63. All right, let's find the order block. It's got to be back here somewhere. There it is. The order block here on June 10th. Why is this an order block? We have a swing low. we have a swing high, we have a lower swing low, and we break market structure to the upside. Okay, all right, we broke market structure to the upside. Now we can define the order block, the lowest closing bar before market structure. Remember, look, swing low, swing high, lower swing low, market structure change. Defines the order block, the high and the low, bring it all the way back in. Look, when we were up here in August, way sky high, again, in hindsight, were the people buying in this order block, was that smart money? Yeah, clearly it was. So now we know this level is smart money. So we bring it into the future if and only if it gets back there. Okay, might be interested to take the trade in the place where the smart money bought in the first place. That's exactly what happened. So I took the trade here on 10-3. Excuse me, 11-3, November 3rd. Why? Rejection of the bottom of the order block this time. Do you see how during the day we went below the order block, then we closed back above it, or closed back into it? Great. I entered 56.63. I placed my emergency stop 2 ATRs below. My end of bar stop is very close, everybody. It's just a close below the low of the order block. Look, I entered here, the low of the order block's there. It's a very good risk to reward ratio, okay? So as soon as I enter and I have my emergency stop, end of bar stop, I place my trailing stop level how far above? 1.5 ATRs above, and off we go. Next day, up a little. Next day, up, profit target. Fantastic. Next day, it was up and then it closed a little lower, but I sold into that strength. Thursday, up a little, not much. Friday, up, nice. Enough for me to have a profit target. Now, look, I'm not at trailing stop level yet. So if I have a close below previous bar's low, I don't do anything. But if we get to trailing stop level, then I go into trailing stop mode, close below previous bar's low. So this particular trade, doing fine. Again, very happy because of the week we have that I have something up 2.45%. It's not bad. Now, I wrote myself a little note here, CPM. Well, listen, MO is Altria. PM is Philip Morris. Altria is the U.S. division. Okay, Philip Morris is the international division. But let's go to Philip Morris, because I have two students that took this trade, and very happy for them. Steve, Vivek, look at this. They bought Philip Morris here on the 3rd. Why? Rejection of the bottom of the order block. Okay, here's the order block. That's the order block from the past. We were below it, yet we closed back in it. And that's about as good as a risk to reward ratio that you're going to get. Next day, if it just closes below, out. Look at this great trade. Super good risk to reward ratio. So congratulations, Vivek. Congratulations, Steve, on this nice, beautiful trade. Like super easy trade, right? This is the greatest type of trades are the ones you just take and they just go, okay, great, we're going up. And it started right off the bat. So fantastic. Good job, guys, on Philip Morris. Let me go back here. And that brings up another topic that I wanted to discuss. One of my students, Steve, was asking me, Greg, how do you trade in in a bear market? There are not going to be any signals. Well, really, there's always going to be signals with something, because if there's a bear market in tech stocks, other stocks, there's always going to be a beneficiary that's going to go up in a bear market, like bonds, like MO, like Philip Morris, right? Like the safety stocks, the consumer defensive stocks. So even if we are going to go into a bear market, even if, or a significant sell-off or pullback, it doesn't mean that there's not going to be anything to trade, because there's always beneficiary. If the regular market goes down, there's always other things that go up, and you're going to see that in the charts. And Altria, MO here, or Philip Morris are perfect examples of that. All right, a little off the topic, but I just did want to mention that because I kind of thought it all wove together. But yeah, so here on my trade, the remaining shares I have on MO Altria up 2.4%. XLE is the energy sector ETF. Right, we have an order block here. What makes it an order block? Well, check it out. swing low, swing high, lower swing low. We move, go above that swing high, changes market structure. Now I know the order block. Lowest closing bar before market structure change. Here's the high, here's the low. Move it into the future. Okay. After it changed market structure, it continued to move up a little bit, then pulled back. I got long here XLE on November 4th at 87.18. Why did I take the trade? Two signals, two primary signals. First, did we reject the order block on this day? We did. After we changed market structure to the upside, we came down, went into the order block, closed back above it. That is called a rejection of the top of the order block, right? What else happened? We rejected the 200-day moving average. Remember, rejection of the 200, 250, 300, or a 30 RSI, that is a deep dip buy approach signal. It's legitimate on its own. But when you combine it with the fact that it rejected the high of the order block, it just makes that trade that much stronger. So I did get in 87.18, position size correctly, placed my emergency stop. How far below? 2 ATRs. Where's my end of bar stop on this trade? Simply a close below this 200-day moving average. That's it. Look how close I am to it anyway. Next day, closed down, even 1 penny, boom, I'm out. Fine, great, no problem. Just like a casino losing, one throw of the dice. So what? They don't care. Just a loss. They know in the long run their edge is gonna overcome and they're gonna get the money. Well, it's the same here, everybody. So when I have a loss, I really don't stress about it. I'm like, no, it just didn't work, right? But fortunately, this one did work. So rejection of the high of the order block, rejection of the 200-day moving average, emergency stop 2 ATRs below, end of bar stop closed below the 200, place my 1.5 ATR trailing stop level above. Off we go. Next day, up. Nice. Hit some intraday profit targets. Next day, up again. Nice. Profit targets. Next day, up again. Multiple profit targets. And what happened? I am at trailing stop level. Doesn't mean I do anything. It just means now in the future, if I close below a previous bar's low, I'm going to get out of half of the remaining shares that I have. This particular trade really doing quite well. Up 2.63%, 3 days. Not bad. NVDA. All right. I did enter a trade on NVDA on Friday. Why? Rejection of the high of the order block, rejection of the 50-day moving average. I don't just use 300s, 250s, 200s. I'll also use a 100-day moving average if it lives inside the order block. I'll also use a 20-day moving average or a 50 moving average. And this is exactly what I did. So this is NVIDIA. Obviously, it's had quite a big sell-off. I never buy up here. I never chase this stuff up here, right? Thankfully, because look what happened. But let's take a look and see if we can find the order block, why this is an order block here. Here, look, on 10/15/25, we had a swing low. Again, swing low, higher low to the left, higher low to the right. Does that look the same? That's right, swing low. Followed by a swing high, lower high to the left, lower high to the right. Does that check out? Yes. Swing low, swing high. Now we need another swing low that's lower than the first swing low. Does this qualify? Sure did. This low is lower than this low. Swing low, swing high, swing low. Boom. Here on this day, we take out the swing high. What happens? We change market structure to the upside. Does it work? Yeah, certainly does. But more importantly, for me, as soon as it happens, now it defines the order block. I look to the left. Where's my lowest closing bar before market structure change? Here, high and the low. Bring that into the future. Again, people buying here, when we're up here and you look back here, was smart money buying here? Yeah, clearly it was, right? Clearly, in hindsight, it was. So why did I take the trade here on Friday? Well, we rejected the top of the order block. Clearly, we came into the order block, we closed above it. Yep. And we rejected the 50-day moving average as well. We were below it during the day, closed above it. So that's why I took the trade, everyone. I entered the trade at 188.22. I position size correctly with the formula that I showed you. 1% of your total trading capital divided by the value of the 2 ATRs shows you how many shares I buy. Place my emergency stop 2 ATRs below my end of bar stop, simply close below the 50-day moving average. And then I place my 1.5 ATR trailing stop level above my entry. So it's not there yet. I just barely took the trade. It's even. So I have no control over what NVIDIA is going to do here, but I know exactly what I'm going to do regardless of what NVIDIA does. If it goes up a little bit, I'm going to take some profit target. If it goes down a little bit but stays above the 50, I'm in. If it goes down, close below the 50, I'm out. If it crashes down, hits the 2 ATR emergency stop, boom, I'm out. I know I lost 1%. All right. If it moves up, continues to move up, I'll continue to take profits. If it gets to trailing stop mode, boom, I go in trailing stop mode. Then if I have a close below previous bars low, I get out of half. Now, if we get up to the 65 RSI level or 70 RSI level, then I have other rules on how to exit up at those levels as well. So, okay, so those are the open positions. Disney remaining shares up 0.78%. Costco remaining shares up 1.24%. USO Oil remaining shares up 4.83%. Altria up 2.45%. XLE up 2.61%. And NVIDIA break even. All right, let's talk about the daily swing trades that I closed out of this week. And let's go to Pfizer. So I entered Pfizer here on the 17th of October. Why? Rejection of the bottom of the green order block and rejection of the 200-day moving average. Got in at 24.09. Okay. Place my emergency stop 2 ATRs below. My end of bar stop simply closed below the 200-day moving average. This trade didn't do much. It basically just moved sideways, moved up a little, hit a profit target there, kind of did nothing for a few days, then went down, but it continued. You can see we came down, tested the 200 here, tested the 200 here. That kept me in the trade. Then we did have kind of a nice up bar day where I did hit a profit target. And then the next day I had to exit. Why? Because earnings were the next day and I don't hold through earnings. So I just exited the trade and the remaining shares that I had a gain of 0.66%. So not a big trade. It's fine. It was a little bit, but again, I don't hold through earnings. So that is why I exited the trade right before earnings for a gain of 0.66%. And then Meta. All right, Meta, I did exit for a loss. I really like this particular trade. This was an order block from the past. And then inside that order block, well, here I'll show you. The thing is, it's just so far away that it's kind of hard to see on the screen. So I apologize for that. My goodness. All right. So this order block was all the way from May 23rd. Swing low, swing high, lower swing low, market structure change. After we changed market structure to the upside, it just went up and it went up and it went up and it went up. And again, when you're up here at 795, if you make the statement that people buying at 623, was that smart money? Yeah, of course it was. So again, smart money area comes into the future. If we get back down to that area, I want to be looking to get in. Oh, sorry. There was no major moving average inside the order block. So I look to the left here. What did I have? I had a V2. Bar 1, bar 2, bar 3. 2 goes below 1's low. 3 closes above bar 1's close. That forms a V2. The middle bar of a V2, the number 2 bar of a V2, halfway. That's an important level. That's why I drew the green line here, brought it into the future. And on the day that I entered Meta, why did I enter it? I entered it because 1, it got into the order block, and 2, it rejected that line I just told you about. So I position size, placed my emergency stop below my 1.5 ATRs above. Next day went up. I sold, at least I hit a profit target into that strength, right? So next day it went down and closed below the low of the order block. That got me out of the trade. So I did have a loss of 1.36%, right? Not a big loss. But taking the partial profit you see how that was beneficial, that at least I took some off at a profitable level, which gave me fewer remaining shares. And so then the fewer remaining shares went down, but it went down on fewer shares than more shares. So you can see that that helps a little bit with this particular loss, right? That's the importance of taking the partial profit. So I did get out with a loss of 1.36%. Okay, so those are all the open trades and the open daily trades and the closed daily trades. And now let's go over to the weeklies, okay? Weekly bars close on Friday. I make my buying and selling decisions based upon Friday's close on the weekly bar. I got long XLV all the way back here on 8th of August at 130.07. Why did I enter this trade? Well, here we have an order block from the past. Here we have a deep dip by 300 week moving average living inside of it. I love the combination of the two. I entered here on the 8th because for two reasons. We bounced at the 300-day moving average. That's a legit deep dip buy signal. And we also rejected the high of the order block. That's an order block signal. So I got in here 130.07 position size, placed my emergency stop 2 ATRs below. My end of bar stops have closed below the 300-week moving average. I placed my trailing stop level 1.5 ATRs above. Next week takes off like a rocket ship. Sold into that strength, hit multiple weekly profit target or 0.45 profit targets into that strength. Next week up again, took some more profit targets, got to trailing stop level. Now I'm in trailing stop mode. Then we move sideways for about a month. And then here we have our first close below a previous bar's low after reaching trailing stop level. What do? I take off half of the remaining shares that I have and locked in a gain of 3.99%. Next week, boom, off to the races again. Glad I kept that half, right? Instead of selling it all. That's why I only sell half. Up again, multiple profit targets. And then we were down the next week, down, up a little next week, then up again, profit target here. And then we've kind of moved sideways from there. Right now, we're at a 60.19 RSI. If we get to a 65 RSI, now I go into 5 EMA mode, which just means now in the future, if we're not there, we're at 60.19, but if I get to 65 RSI, now the 5 EMA comes into play. If we get to 65, then we close below the 5 EMA, then that is the end of the trade. Also, if we reject the 70 RSI, I get out of half, and then if I have a close below previous bar's low after rejecting 70, get out of half, then out of the full position as well. So if and when that happens, I will show you that and explain that to you. But the remaining shares that I have here at the moment, doing quite well, up 10.98%. All right, last position on the weeklies is UUP. I entered UUP back here on 7/11. Why? Two signals. Rejection of high of the green order block. You can see we're closed in it, then we closed above it. That's rejection of the high. And deep dip buy, close over the 200-week moving average. Entered here 27.21. Place my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200-day moving average. Place my 1.5 ATR trailing stop level above. And here we go. We start the trade. Boom. Moves up right away. Hit a profit target. Next week, down. Test the 200 again, but closes above, keeps me in the trade. Next week, up big. Up biggies, right? Multiple profit targets, and I'm in trailing stop mode. Next week down. This week, here we have our first close below a previous bar's low after reaching trailing stop level. I take off half the remaining shares for a gain of 5.41%. Then we kind of move around here for about a month. This week was interesting. We had a big sell-off, but that sell-off reversed, closed above the 200, kept me in the trade. Had it closed below the 200, I'm out, right? But it closed above, that kept me in the trade. Next week, up, more partial profits. Next week, nothing burger. Next week, up, multiple profit targets, a couple weeks sideways. Week before last, up, multiple profit targets. And then this week, down a little bit. Okay, so this particular trade doing quite well on the weekly, up 3.41%, which is a lot for a currency. So there you go, everybody. I mean, really good trades. Only had one losing trade out of 1, 2, 3, 4, 5, 6, 7, 8. It's pretty good. You know, I'm not tooting my horn. I'm just saying, based upon last week with the volatility and the big down moves we had in the markets, there were some winners here, and luckily I was in them. Why was I in them? Well, because it started with a good foundation of taking the trade. And if you start any trade with a good foundation, meaning you have multiple confluences, different strategies, levels, signals that happen, it stacks the odds in your favor in a big way. So again, very grateful to be up on this week, considering what happened last week, and so steady as she goes, right? Okay, so listen, before we start looking at the potential trades for next week, let's talk a little bit about trader psychology first. How about that? Okay, this is from Trading Composure, one of my favorite channels on Twitter X. And follow Trading Composure at Trading Composure, spelled a little interesting, TradingComposur. So there's no E on the end. But great channel to follow. And he always posts very relevant and thoughtful and nuanced post about trading, and so whenever I see posts from him come up, I love to watch them. So this is very simple, but let's read it. You don't rise to the level of your intentions. You fall to the level of your preparation. Now, this is trading related, but this could be anything, right? This could be baseball. This could be guitar. This could be in your business. We always have these intentions, right? Man, I'm going to hit 5 home runs, or I'm going to get a hole in one, or I'm going to, play Stairway to Heaven on my guitar or whatever, right? But just because you have the intention doesn't make you rise to be able to complete and succeed at your intention. You fall to the level of your preparation, meaning your results are going to be based upon your preparation. If you want to hit home runs, you've got to practice hitting every day, right? You want to play guitar and you want to play a certain song and you want to play it well, you have to be, it's all going to come down to what your preparation was. Did you practice? Did you study, right? With a diet, hey man, my intention, I'm going to lose a lot of weight. Well, if you don't prepare to do that, if you're not eating less, eating better food, exercising, you can have all the intentions you want, but it's based upon the actions that you've taken, right? So you don't rise to the level of your intentions, you fall to the level of your preparation. And I think a lot of people have this mistake in trading. There is a lot of preparation and study that goes into trading. At least for me, I study every day. I go through my charts every day, right? Small things. I lay things out, I write them down, they're in front of me so that I don't miss stuff, right? Like, so something doesn't slip between the cracks. Oh, I didn't take that trade because I was, doing something else and I lost my attention, right? So it's the small steps in your process during the day. Have you written your stuff down? Do you know what you're doing? Are you going to avoid making mistakes or trading errors because you're organized? Did you study the charts? Do you have your levels marked out? Right? Everyone thinks, okay, I'm going to start trading. I'm going to buy my Lambo, right? Be chilling on the yacht. Man, that's all bullcrap. Just like a great pianist or a great doctor or a great athlete, it's preparation. You think you see LeBron James, he's just chilling all the time, hanging out with his friends, and no, That dude's working out. That dude's studying his game. That guy's taking super cold, uncomfortable ice baths after every game. That's the stuff you don't see, right? What's going on underneath. And it's the same for trading, everybody. You have to take it serious. You have to study. You have to be organized. You have to look at your charts. You have to sleep well, all this stuff. So preparation, preparation, preparation is what you need on all levels. Being organized, studying your charts, being in a good mental state of mind so that you don't make mistakes. So, if you're having problems with your trading, up your game. Up your game. Do it better. Do it better. Make it a priority. Don't let friends distract you, the internet distract you, your cat distract you, right? This is serious. And the more serious you get about it and the more prepared you are for your trading, that's when you're that's when you're going to hit some of your goals. But again, you're going to fall to the level of your preparation. If your preparation is way down there, that's what you're going to fall to. If your preparation's high, you're not going to fall as much, right? So keep your level of preparation as high as possible and your results will be as high as possible. So thank you, Trading Composure. Always appreciate your great posts. And thanks for posting this. It was really helpful. All right, everybody, let's get on to the potential setups and trades that I'm looking at for next week. Excuse me. Okay, so these are all on the dailies. Now, here I have 17 potential trades for next week. Now, I always mention this because it's relevant. Look, I have 17 potential trades. These could all theoretically trigger on Monday. Does that mean I'm going to take all 17 trades? Absolutely not. I'm going to take uno. I'm going to take one trade. I'm going to take the best trade. How do I decide if they're all legit? How do I decide? Well, I have to give them a report card. In simplistic terms, if I have one signal, I give it a score of 1. If I have 2 signals, I give it a score of 2. If I have another one that has 3 signals, score of 3. Okay, I'm likely to take the third. But a lot of times, if you have something that have multiple signals, the chances that your risk to reward ratio is not that great goes up. So even if something has 5 signals, I may not take the trade because maybe it's extended already and the risk to reward ratio is not good. So it's very nuanced, right? I have to look at the big picture. Are there divergences, ATR divergences, RSI divergences? How many signals were there? But what's the risk to reward ratio? I also like to look at the higher time frame to see if I can find some support from moving averages or V1s or order blocks that also dovetail in higher time frames. I also take into account the relative strength of that particular market. Maybe the market's down in general on that day, but one particular stock is up. Okay, I take that in consideration. That adds a little kind of nuance bonus point to that, right? So the devil's in the details with trading, everybody. Comes back to preparation, being clear-minded, thinking, and making good decisions. And so this is how I trade. This is how I try to lead my life, and this is what I teach my students. And by the way, I do teach a private one-on-one course. I have taught people from all over the world. It's a 20-hour course. One-on-one, I think it's the best way to learn anything. I teach you all the strategies that I use. I teach you all the everything I've learned from the last 30 plus years of trading. And our class, the one-on-one class, we do it on Microsoft Teams, 2 hours each week for 10 weeks. So we'll be hanging out for 10 weeks, looking at how the market changes over that 10 weeks. I have taught people from absolute beginners that didn't even know what a chart was, all the way up to the hedge fund level. And I consult with, and I consult monthly with hedge funds as well, and people everywhere in between. So if you would like to learn to trade like I do, if you want somebody that loves to teach, and I believe I am a really good teacher, please send me an email. The email is in the link in my description, And if I receive an email from you, I'll write you back and say, hey, great, thanks for saying hello. You know, if you're interested in moving forward, let's have a free video call. It's not a sales call, I promise you that. I just want to learn more about you, your trading challenges, your trading goals, and it's a good time for you to ask me questions about the format of the course, right? And then we can kind of see if we're a good fit. But if you're interested, please send me an email, and when we get started, I'll teach you everything I know. As an alternative to the live one-on-one course, I also have a really good video course available at udemy.com. The link's in the description of the YouTube description below. It's a really good course. It's a really good way to get started. That video is very affordable. It's somewhere between $50 and $100 on udemy.com. It's 9.5 hours of video, and I teach you step by step the deep dip buy strategy. And it's a really good course. I think I have like 4.8 or 4.85 stars on that, and I've sold those all around the world. So, you know, 2 resources for you. The 20-hour one-on-one course, obviously the best, and then the udemy.com. That's a good starter point as well. So anyway, there's my plug for the day. Appreciate you hanging on and listening through this. And so let's get started and take a look at these potential trades for next week. All right, here's Amazon, AMZN. All right, I have a bearish abandoned baby up here. You can see the bar with the red circle. Why is this in what makes this a bearish abandoned baby? Well, look at the day before. We were way down, and then boom, we gapped way up. Man, must have been good news. Everyone's pumped. Sentiment very, very bullish. But what happens the next day? Next day, immediate gap down. There's your clue. If you have a very fast change in sentiment, and in this case, bullish sentiment with the gap up, an immediate bearish sentiment when the gap down, a lot is going on here. But this simple way to look at this is when you have an abandoned baby, more times than not in the future, you're going to be lower than higher. Now, did that happen? We gapped up, we gapped down. Yeah. Did it head down? Yes, it did. Did I take the trade? No, I did not. What I'm looking for, what I have found in my experience, the best place to take a trade on a bearish abandoned baby is when, after the abandoned baby happens, and you get a pullback to the bottom of that abandoned baby. Well, the bottom of that abandoned baby is 253. So we gapped up, we gapped down. Yes, we did go down, but I'm relying on a counter punch. I'm relying on a check back, an attempted rally back to this level. And if in the future we do rally, but then we reject this level, that is where I would potentially take the trade. Now, with an abandoned baby, I don't have the emergency stop, or well, I do have the emergency stop, but I don't have the end of day stop. I don't take profit targets. This is the one strategy. It's very simple. Like for instance, if we had done this on Friday, I can move the bar. If we'd have done that I would have taken the trade because we had the bearish band of baby. We had a reflex rally back up, rejection at the bottom. At this point, I would place my 2 ATR emergency stop above here as always, and then I'd simply place a 4 ATR profit target below. And that's kind of a set it and forget it trade. I'm either going to lose two ATRs to make 4 ATRs. But in my experience, the success rate on this is over 70% that it goes my way. So there's about a 70% chance I'm going to make twice as much than a 30% chance where I'm going to lose half as much. Make sense? So that's what I'm looking for. We'll see. You know, if the market kind of washed itself out on Friday and reversed back up, it's potential. It is potential. So essentially, I'm looking for a short with the rejection of 253. DoorDash. Okay. It's pretty nasty, everybody. Look at that. Everybody just had to have it up here near the 3rd ATR channel. Yep, it's going to the moon. Yeah, not so much. So when something happens like this, I have to look back and go, okay, where's the order block? All right, well, order block's back here, 5, 5, 6. High and the low. We have a swing low. We have a swing high. We have a lower swing low. We have a market structure change. Defines the order block, moves the order block in the future. Now, Are there any major moving averages inside this order block? No, they are not. They are above us. Not a good sign. So what I'm looking for on DoorDash, simply because I'm not really excited about getting into DoorDash, but at some point I may be interested, is a rejection of the bottom of this order block here at about 111.7493. If we continue to move down, reject that order block, close back in, sure, I'll take a shot at it. I'll take a shot at it. Right now, alternatively, if we have a bullish abandoned baby inside this order block, could also take that. What's a bullish abandoned baby? That's when you gap down and then you immediately gap up. It's just the opposite of what it just showed you. So there's a potential with DoorDash right here, although I can't predict it. The only thing I can kind of say here for the record on DoorDash is that if we reject the bottom of the order block, 174.93, I will consider. Okay, FXY. Oh, good example, good example. This is the Japanese yen. Okay, I just talked to you about bullish abandoned babies or potential abandoned babies. Here you go. Here you have one. Congratulations on the new bullish baby on FXY. Why is it bullish? Look, here we gap down overnight. The news was bad. However, the very next day, boom, never mind. We like it now. Very quick change in sentiment from bearish to bullish very quickly. Now, did I take the trade? Not yet. Once this happens, now, because this is a bullish, we have the high of the order block, 59.76. That is the supportive area. So next week, if we come down, retest that level, close back above it, in that situation, I would potentially get long. And because it's a baby, same thing. I placed 2 ATR stop below me, 4 ATR profit target above me. Set it and forget it trade, right? I'm either going to lose 2 ATRs or going to make 4 ATRs. For example, had it done this on Friday, that'd be my entry. Gap down, gap up, retest the high of the order block, rejects it, close above, sure. But it didn't do that. But that's what I'm waiting for. That's what I'm waiting for it to do. Intel. All right, so Intel's had a really, really nice run here. We have an order block, swing low, swing high, lower swing low, market structure change, defines the high and the low of the order block, lowest closing bar before market structure change, bringing it into the future. Okay, any moving averages in there? No. But what I like is simply the low of this order block. The low of the order block is 34.69, which is just the bottom of the green box. If it rejects that, then closes back above, and it's a nice gentle close, not a big huge move up. You know, I have to consider risk to reward. I would consider taking Intel. Lockheed Martin, LMT. All right, well, this thing went straight up and now straight down. But we are coming into an order block. Here's the order block. 9.325, swing low, swing high, lower swing low, market structure change, and straight up. Again, if you look here at the top, when it was like 515, and then you look back to the order block area, was smart money buying here? Yeah, clearly, obviously, obvio, right? So there's your smart money area. Bring it into the future. Are we there yet? We are not there yet. We're getting pretty close. And this is a very short order block. It's not tall. It's very narrow. So next week, if we close and if we reject the high of the order block, I would consider taking it. If we reject the low of the order block, I would consider taking it. We don't have any moving averages or anything inside here. Well, let me take that back. Look, we have a V2. Bar 1, bar 2, bar 3. 2 goes under bar 1's low, 3 closes above bar 1's close. Therefore, halfway of the washout bar of the V2. Yeah, excuse me, I didn't catch that the first time. Thanks for pointing it out, everybody. Just kidding, right? There you go. There's the line, 448.90. That would be great. But regardless, if we reject the high of the order block, I consider it. If we reject the low of the order block, I would consider it. If we reject this midpoint that I just put in here at 448.90, I would consider it. Clearly it's on sale, right? And we're coming into a previous smart money area. So we'll see how it reacts. MasterCard. All right. This one's pretty simple. Here's the order block that I'm looking at all the way back here on June 20th. We have a V2, bar 1, bar 2, bar 3. 2 goes below bar 1's low. 3 closes above bar 1's close. Therefore, halfway is the 532.90. Run that into the future. That halfway lives inside the bullish order block. So perfect. Now, if we came down and rejected the high of this order block, I wouldn't take it because it's a tall order block. However, if we do reject the midpoint at 532.90, I would consider it. And of course, obviously, if we reject the low of the order block, I would consider that as well. Look up here. What's this in the red? This is a bearish order block, right? It's a bearish order block. So we broke structure here. We came back, we came into the bearish, and it did what it should do. It came down. So there's bullish and there's bearish. And you can see that bearish order block nailed it as well. But now we're getting close to the bullish order block, so I want to concentrate on the long side. McDonald's. All right, pretty simple. Here we have an order block, 10.925. We have a V2, so the midpoint, the bar 2 of the V2. There's 3 bars in a V2, bar 1, 2, 3. 2 goes under 1, 3 closes above bar 1's close. Halfway point is the area of support of the V2, and that also runs nicely in the middle of that order block. So we'll have to see on McDonald's. This is not that high of an order block, so a rejection of the high of the order block I would consider. The rejection there is 295.12. The low is 292.04. And then, of course, we have the midpoint in there where I could also take the trade with the rejection of 293.50. Microsoft. All right, look, Microsoft's come straight down, but this could be a good opportunity to potentially get into Microsoft. We have an order block here. We have a swing low, swing high, swing low. This defines the order block. All right, we are well into the order block. We're getting very close to the bottom of the order block. That's what I'm interested in. And we're near a 30 RSI as well. So if next week we come below the low of the order block and then close back in it, we will have also gone under the 30 RSI and over the 30 RSI. There's your two confluences, order block, deep dip buy. So the low of this order block is 492.37. So that's what I'm looking for. I'm looking for a rejection of the low of the order block and ideally a rejection of the 30 RSI as well. MicroStrategies, MSTR. I know one of my students took this trade on Friday. Why? Rejection of the bottom of the order block, right? Clearly we went below the order block. We close back in the order block. We also have a V1, bar 1, bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. Great. There's your signal. Now, I didn't take this trade because I took NVDA instead, but I will potentially look at taking this trade on Monday. If we go back down and test the bottom of this order block again, it dovetails. See the big up bar we had on Friday? So it would make sense that we would potentially test that bottom. And if we do, and the test holds, that will give me more confidence and more confirmation. So not that this was not a legitimate entry. This is a legitimate entry, but I picked NVIDIA instead. But that's what I'm looking for, is another retest of that bottom of 230.78. Nike. I really like Nike. I really, really like Nike. We have an order block. We're coming to the top of the order block here, but we have this nice order block all the way back here from 618.25. Swing low, swing high, lower swing low, clearly market structure change, defines the order block, bringing it into the future. Look, this order block's pretty narrow, so it almost tested it on Friday. Didn't quite get there, but almost tested it on Friday. Had that tested it, I probably would have got in. But so it didn't, so I didn't take the trade. So a rejection of the high of the order block, 60.21. Rejection of the low of the order block looks like 59. So I'm going to watch Nike very closely. Clearly, it's very much sold off here and coming into a important level. So we'll be watching Nike next week. RBLX. All right. Well, I did not take this trade. I was alerted to this trade from one of my students, Vivek. We're in an order block. And we also, look, we have this megaphone trend line. Swing low, lower swing. See how we take the trend line and we connect these bottoms, we go out into space. In the future, if you do get that third tag of the projected megaphone trend line, that's generally where you will at least stop and bounce. Well, it's pretty much what happened, right? Pretty much what happened. And it did reject the high of the order block. So I didn't take the trade because I took NVDA, but depending next week, I could potentially buy this again if it came back in, maybe retested and closed above the trend line. Because very often when you break above a trend line, it will come back and retest. But we'll see. I don't know. I may have just missed this one, and this one might just keep going up. But again, if it comes back into the order block, maybe a V1, V2 in the order block, rejects the bottom of the order block, that could be a potential or retest of the trend line. Shopify, SHOP, pretty simple. Order block back here on the 2nd of September, swing low, swing high, lower swing low, market structure change, defines the order block. Boom, bring it into the future. What I like about this order block, it was a big up bar. Big up bars, halfway of the big up bars generally has some inherent support. That is at 136. So next week, if we reject the high of the order block, I'll consider it because it's not that tall of an order block. So I will consider it. Secondly, if we reject this 136 mark inside the order block, that would be fantastic. Or, of course, as always, if we reject the bottom of the order block, and the bottom of the order block is 133.40, I would consider taking it there. TLT, I was in TLT for months and months and months, and now I may have a potential trade again. Why? This is on the dailies though. We have an order block, swing low, swing high, lower swing low, market structure change, defines the order block here, lowest closing bar, bring that into the future. We have this up bar inside of the order block. Halfway of that, it's going to be a level of support. You can see here, got right about there, and that's when it took off. So there's two levels inside TLT that I'm looking for. I'm looking for a rejection of 88.73. That's that midpoint that's inside the order block. A rejection of that, perfect. We also have a 250-day moving average inside this order block as well. That 250-day moving average is 88.59. So somewhere in this area, rejections of this particular area would be interesting. Of course, a rejection of the low of the order block would also do it at 88.46. TMC, man. So look at this. I considered taking this trade on TMC all the way back here on 820. Why? Rejection of the high of the order block. But I decided the order block was a little tall and I didn't want to take the trade. And then it more than doubled. Crazy, right? But look, it ran it up and now it's coming back down clearly. But look what we have. We have the 200-day moving average at 460 at the top of the order block. Hey, that's a really good, if we do come down and reject that, that would be a good risk to reward ratio, high probability trade. The only problem is we have earnings here on the 13th, and I don't hold through earnings. So I'm not going to take this trade in anticipation of the earnings, but after earnings, when it does what it's going to do, if things work out that it does reject the 200-day moving average and reject the high of the order block, I would consider taking that as well. And again, that or the high of the order block in that 200-day moving average is about 460. United Airlines, I know my point exactly. It's the 300-day moving average inside the order block. The 300-day moving average is at 85.43. It's way down there. Is it likely to get there? No, not at all. But this is where I want to buy it. Why? Order block. Swing low, swing high, lower swing low. Market structure change defines the order block, the high and the low. That's the smart money area. We have a major moving average living inside the smart money area. To me, that's the most high probability trade. So very unlikely that I'm going to get into this trade. But if for some reason the market reverses more and goes down there, I would. But again, rejection of the 300-day moving average inside the order block. The 300-day moving average is at 85.43 VIX. All right, interesting here. So here's, we created an order block here. Swing low, swing high, lower swing low, market structure change. We had the smart money area for VIX. Well, as the market moved into the smart money area for VIX, the regular market was going up. But as soon as we got into the smart money area for VIX, where the VIX should rally, it rallied. And what happened to the market? The market went down, right? Now look, over the last 2 weeks, the VIX has rallied, meaning the market has gone down, which it has. Then we had the reversal on Friday. So what I'm trying to say here, everybody, is if VIX comes back down into this top order block or this bottom order block, yes, of course, I could potentially take a long position in VIX with a rejection of 33.34, or a rejection of 32.36, or a rejection of 32.39, or a rejection of 30.31, right? For a trade on VIX, those would be the levels because it's coming back into bullish order blocks. But what I'm saying is be careful. If you see VIX coming back down into these levels, very likely, not 100%, but very likely, if VIX gets down to those levels, that means the market will have rallied. If the market rallies and VIX gets down into those levels, that's probably where the market's going to come back down. I can't say for sure, right? Obviously, but there's a greater chance of that happening. So really what I'm saying, two things. If you're looking, or I'm looking for potential trade on VIX, right? To get long VIX, because I went long VIX here, right? I did do exactly that and had a very good trade on it. But so if VIX comes, rejects the high, the order block 33.32, potentially get long with rejection at 32.60. Now we have this new order block down here. Why? Swing low, swing high, lower swing low. Friday changed market structure to, again, defining a new order block down here, bullish order block. But so from a trade perspective, this is what I'm looking for, to potentially get long VIX. But from a market perspective, I'm just kind of saying that if we do get into these levels on VIX, if VIX goes down and the market goes up, but VIX gets to these levels, very likely VIX is going to bounce from there, which implies the market will go down from there. All right, that was a long explanation. XLF, last one, thank goodness. All right, pretty simple. We have an order block from the past. We have a 200-day moving average inside the order block. Perfect. The only way I'm going to get interested on XLF is if we come down, reject the 200-day moving average. 200-day moving average is 51.31. If we reject it, bounce, close under, close over, great. I'll take the trade. I'll take a punt at it. We'll see what happens. This is a key level. If it holds, great. Make some money. If it doesn't hold, great. Get out. Most likely lose a little money. Okay, everybody. That was a lot of talking. So I hope you appreciated the podcast. If you did, I appreciate it if you would subscribe or hit the thumbs up button. If I can help you with your trading, if you would like me to be your instructor and teach you everything I know, just reach out to me. Love to have you as a student. I'll teach you everything I know. I'll give the lessons 110%, and I think you'll have a skill that you can use for the rest of your life. If you can try to go out, do something nice for somebody today, just a good habit. Try to do one nice thing for another human being every day. If we all did that, the world really would be a better place. If you have it in you, if you have the opportunity, and you could do one nice thing for an animal each day, they appreciate acts of kindness just like we do, everybody. just good karma, right? So I appreciate you being here. I hope you have a good rest of your weekend. Do your preparation for your trading, right? Make your trading better, prepare with it. If you have any questions, please leave them in the comment section. I'll do my best to get back to you, but enjoy the rest of your weekend. Please be careful next week, everyone, and I really appreciate you if you've watched it all the way to the end. So thanks a lot, everybody. Take care. Bye-bye.
U.S. government requires stock options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.